Imagine slashing a third of your company's operating budget, right? Going on this just brutal corporate diet.
Yeah, really cutting down to the bone.
Exactly. Letting go of staff, consolidating your real estate footprint, and somehow, despite all of that, still growing your top-line revenue by double digits.
I mean, in the advanced manufacturing space, that combination is usually, well, it's basically mathematically impossible.
Right. You cannot starve the engine and expect the car to suddenly accelerate.
No, it defies the standard gravity of capital-intensive industries. Like when you cut that deeply into an industrial manufacturer, the top line almost always bleeds out.
Yeah.
So to see revenue spike simultaneously, it suggests this fundamental rewiring of the company's DNA, not just some temporary balance sheet trick.
And figuring out whether this rewiring is permanent or just a fleeting illusion, well, that's our mission today. So welcome to this deep dive.
Glad to be here.
For those of you following our Talk Tickers framework, you know we're taking a heavily data-forward, hyper-analytical approach to the Q1 2026 earnings call for 3D Systems.
Trading under the ticker symbol DDD for those checking their portfolios.
Right, DDD. We are going to strip away the executive optimism, translate all the heavily adjusted Wall Street metrics, and really figure out if this legacy additive manufacturing giant is finally climbing out of what's been a multi-year industry-wide depression.
Because, I mean, the additive manufacturing sector has been an absolute graveyard for capital over the last 36 months.
It really has.
We've seen competitors fold, merge, or just pivot into total obscurity as global interest rates basically choked off enterprise capital expenditure.
Yeah, nobody was buying anything.
Right. So any signal of a breakout here is going to have massive ripple effects across the entire hardware supply chain.
Okay, let's unpack this. Following our Talk Ticker structure, we always start with the headline numbers. And looking at the transcript from CEO Dr. Jeffrey Graves and CFO Phyllis Nordstrom, the top-line growth is just an immediate shock to the system.
Oh, absolutely.
Q1 2026 revenue came in at $95.5 million. That is an 11% year-over-year increase.
And that double-digit figure carries a lot of weight when you consider the macroeconomic backdrop.
Definitely.
For the better part of 2 years, hospital networks, aerospace prime contractors, automotive manufacturers.
They've all just been hoarding cash?
Exactly. When the cost of capital spikes, the very first thing a CFO freezes is the procurement of multi-million-dollar experimental manufacturing systems.
Right. They just squeeze another year or two of life out of their legacy milling machines and casting foundries.
Yeah, make do with what we have is the mantra. So generating an 11% top-line bump implies that the purchasing freeze is finally thawing out.
Enterprise customers aren't just, looking at brochures anymore. They're actually signing purchase orders.
Right.
But, and I always say this, top-line revenue is the easiest metric to manipulate if you're willing to just destroy your margins.
Oh, for sure. Selling $1 for 90 cents will get you fantastic top-line growth all day long.
Exactly. The real diagnostic test is the bottom line. And the profitability metrics presented here require some serious translation because the company underwent a massive structural change in 2025.
Yeah, we really have to look through the noise of their recent divestitures to understand the core operational health today.
So where do we start with the numbers?
Let's start with the non-GAAP loss per share, which contracted to just a single penny.
Just 1 cent.
Right, a dealian or 1 cent loss per share, compared to a deal or normal 21 cent loss in the prior year period.
Now, on the surface, a 20-cent improvement per share sounds like, pocket change.
Literally.
But when you multiply that across roughly 130 million outstanding shares, you are talking about staunching an enormous cash bleed.
Huge. But to isolate the cash-generating ability of the actual hardware and materials business that remains today, we need to focus on adjusted EBITDA.
Okay, lay it on me.
In Q1 2026, 3D Systems flipped from a massive deficit into a positive $2.1 million in adjusted EBITDA.
So they are finally generating positive earnings before interest, taxes, depreciation, and amortization.
Yes. But here is where we really need to factor in the ghosts of 2025, like you hinted at.
Right.
CFO Phyllis Nordstrom made it abundantly clear that the raw year-over-year comparison is heavily skewed. Because 3D Systems sold off 3 major software assets last year.
Geomagic, 3D Expert, and Akanon.
Right. And selling those software divisions fundamentally altered their margin profile.
Because software margins are incredible.
Exactly. Software businesses typically command massive 80+% growth margins. So when you strip that high margin revenue out of the historical baseline, you are left comparing a hybrid hardware software company in 2025 against a pure play hardware and materials company in 2026.
Okay, so if we remove the ghost revenue and the ghost expenses of those three software platforms from the Q1 2025 numbers.
Just level the playing field.
Yeah, and just compare the legacy hardware business then to the hardware business now. What is the actual delta? Like, what's the real swing?
When you establish that true apples-to-apples baseline, that positive $2.1 million adjusted EBITDA in Q1 2026 represents a $28.2 million bottom line improvement. Yeah, over the core business's performance in the exact same quarter last year.
A $28 million operational swing in a single quarter for a company doing under $100 million in quarterly revenue.
It's staggering.
That is a colossal shift in operating leverage. And we see that flow directly into the unit economics, right? Because the non-GAAP gross margin hit 36.1%, which is a 600 basis point expansion from the prior year.
Which is huge. And management attributed that margin expansion to two highly technical factors: improved manufacturing absorption and optimized sales performance.
Okay, let's translate manufacturing absorption for a minute, because that sounds like factory floor jargon to most retail investors.
It absolutely is.
My understanding is that when a factory is running at, say, 40% capacity, the fixed costs, the rent, the electricity, the salary of the plant manager, all of that is spread across a very small number of 3D printers actually rolling off the line.
Right.
So each individual printer carries this massive burden of overhead, which just crushes the profit margin.
That captures the mechanism perfectly. As demand returns and they ramp up production, say moving to 75% or 80% capacity utilization, those fixed costs are absorbed by a much larger volume of product.
Makes sense.
So the unit cost of each printer drops precipitously, and the gross margin inherently expands. It's basically the classical beauty of operational scale kicking back into gear after a really prolonged slump.
So if I'm looking at this operational diet they went on, my immediate thought is whether they've just, hollowed out the core.
Yeah, did they cut too deep?
Exactly. Is this a sustainable turnaround, or did they just sell off the furniture to make the quarterly revenue look good? Like, did they leverage the cash from the software divestitures to temporarily beautify the balance sheet, or did they actually change how the factory operates?
The non-GAAP operating expenses provide the clearest answer to that. Management didn't just sell assets, they took a scalpel to their daily operating structure.
What did they cut?
They slashed non-GAAP OPEX by 35%.
35%.
Yeah, bringing it down to $36.6 million for the quarter.
Literally erasing a third of your ongoing operating expenses. I mean, how do you physically accomplish that without crippling your ability to fulfill orders or service existing clients?
It requires a systemic dismantling of corporate bloat. Dr. Graves outlined a defined 6-quarter cost reduction program.
Okay.
And it targeted everything from consolidating their real estate footprint, so closing redundant facilities and moving production lines under a single roof, to renegotiating supply chain contracts and, frankly, flattening middle management.
Just ripping out the inefficient.
Exactly. By the end of Q1, they had realized $55 million in annualized cost savings.
$55 million permanently removed from the annual expense run rate.
Yep. Yeah.
And the CFO stated they expect to finalize the last phases of these cost reduction programs by the end of Q2. So we are looking at a fundamentally leaner entity moving forward.
And that lean structure is the vital prerequisite for the margin expansion we just discussed. They lowered the break-even point of the entire corporation.
Right. So now every incremental dollar of revenue that comes through the door drops straight to the bottom line, with much less friction.
Precisely.
Well, that perfectly frames the headline numbers. They survived the capital expenditure drought, they ruthlessly cut the fat, and they are capturing the initial wave of returning demand.
They weathered the storm.
They did. Yeah. But knowing that revenue is growing is totally useless if we don't know where it's coming from. Which brings us to the second pillar of our talk tickers analysis: the story behind the numbers.
And this is where it gets really interesting.
Oh, yeah. Because looking at the revenue breakdown, something completely unprecedented happened this quarter regarding their internal power structure.
Yeah, the historical identity of 3D Systems was essentially inverted.
The segment flip.
Right.
Because for decades, if you asked an analyst what 3D Systems did, they would tell you it's an industrial rapid prototyping company that, happens to dabble in healthcare applications on the side.
A side hustle, basically.
Exactly. But in Q1 2026, Healthcare Solutions generated $50.1 million in revenue. Industrial Solutions generated $45.4 million. Healthcare is now officially the largest segment of the company.
Furthermore, the growth trajectories of the two segments are just drastically diverging.
Give me the numbers.
That $50.1 million from healthcare represents a 21% year-over-year surge. The industrial side, while still positive, grew at a much more anemic 1.6%.
So healthcare isn't just the new heavyweight champion by sheer mass. It possesses virtually all of the company's forward momentum.
It does, and this segment flip wasn't some accident of macroeconomic timing.
Oh.
It represents the payout of a highly controversial strategic gamble that CEO Dr. Jeffrey Graves made during the absolute worst depths of the industry trough.
Right. When the company was desperate for cash and slashing that $55 million in operating expenses, the standard corporate playbook dictates that you freeze all long-term research and development.
We should just stop tinkering in the lab and focus entirely on selling what you already have in the warehouse to stay alive.
Exactly. Yet Dr. Graves deliberately ring-fenced the R&D budget. He explicitly noted on the call that despite the intense cost pressures, they sustained their investments in engineering and material science.
But they didn't just scatter that funding across every potential use case. They ruthlessly concentrated their R&D capital into 3 hyper-specific high-barrier markets: aerospace and defense, MedTech, and dental.
They completely abandoned the commodity game.
Totally.
They walked away from trying to sell cheap desktop plastic extrusion printers to hobbyists and mid-tier design firms, which, let's be honest, is just a race to the bottom against cheap overseas manufacturing.
And the strategic logic here is paramount for investors to grasp. The markets they targeted, A&D, MedTech, dental, have extreme, unforgiving requirements.
Right.
A hospital cannot use a generic plastic resin to print a surgical guide, right? It requires a biocompatible, sterilizable polymer that has passed years of FDA safety trials.
You can't cut corners on that.
And a defense contractor cannot use a commercial-grade metal printer to fabricate a rocket nozzle. They need a system that can certify the microscopic metallurgical integrity of every single layer of titanium powder to prevent, a catastrophic failure in orbit.
The barriers to entry are monstrous.
Right.
But the flip side of a high barrier to entry is that once you climb over it, you are sitting inside a fortress.
A very profitable fortress.
Right. It creates an incredibly durable protective moat against competition.
And because they shielded their R&D teams during the downturn, they emerged into Q1 2026 not with legacy machines, but with a completely refreshed hardware portfolio.
Yeah. Dr. Graves boasted about rolling out new direct metal printing architectures and 5 major polymer platforms. He stated verbatim, "No company in our industry can match this range of technologies, nor the product performance that these systems can deliver."
It's a bold claim.
Very bold.
But the 21% growth in healthcare suggests the market is actually validating it.
Well, I want to spend a significant amount of time breaking down this healthcare juggernaut because it's operating in 2 distinct lanes, MedTech and dental.
Okay, let's look at MedTech first.
Yeah, what specific medical procedures are driving this kind of explosive hardware demand?
The primary catalyst is the accelerating adoption of additively manufactured orthopedic implants. Specifically, they're seeing massive demand from medical device companies for the production of titanium spinal cages and cobalt chrome joint implants.
Let's drill down into the mechanics of that, because it highlights exactly why 3D printing is replacing traditional manufacturing in this specific vertical.
It's fascinating.
If I need a spinal fusion, historically, a manufacturer would take a solid block of titanium and use a CNC milling machine to carve away the metal until they had a small, rigid implant.
Right. And traditional subtractive manufacturing can easily create the macro shape of the implant.
The outward shape.
Exactly. The failure point lies at the microscopic level. Human bone, specifically osteoblasts, the cells that actually synthesize bone, does not naturally want to attach to a sheer flat sheet of milled titanium.
It just slides off.
Yeah. The biological integration is often poor, which leads to implant loosening over time.
Which means revision surgeries, complications, and massive liabilities for the healthcare provider. Nobody wants that.
Now contrast that with a direct metal printer like a DMP 350 that management highlighted as a major sales driver this quarter.
Okay.
Because the printer builds the implant layer by microscopic layer out of titanium powder, the engineers can design the interior of the implant to be porous.
Like a sponge.
Exactly. They can intentionally print a complex 3-dimensional lattice structure that mimics the exact trabecular geometry of natural cancellous bone.
So you are essentially printing an artificial metallic sponge.
A highly engineered sponge, yes. And when a surgeon implants that 3D printed titanium lattice into the spine, the patient's natural bone tissue actually grows into the pores, vascularizes, and permanently fuses the implant to the skeleton.
That is wild.
The clinical outcomes are vastly superior, and this is why medical device prime contractors are currently in a massive expansion cycle, buying fleets of DMP 350s to bring this capability in-house.
The demand is clear, but selling a multi-million-dollar metal printer to a highly regulated medical device company is not like selling a software subscription.
Oh, not at all.
Dr. Graves spent a lot of time on the call outlining what he called a three-phase growth model for their enterprise healthcare clients.
Right.
And for you, the investor trying to model future cash flows, understanding this specific sales cycle is critical because it dictates the timeline of revenue recognition.
The B2B sales cycle in regulated medical manufacturing is just an exercise in extreme patience, and this three-phase model perfectly illustrates this.
Break it down for us.
Phase 1 is defined as process development.
So let's walk through a hypothetical scenario. A massive orthopedic company comes to 3D Systems and says, we want to design a revolutionary new knee replacement. They don't just buy a printer and start experimenting in their garage.
Far from it. In phase 1, 3D Systems acts as an integrated R&D partner. Their materials scientists and biomechanical engineers collaborate directly with the client.
They have to figure out the recipe.
Exactly. They have to select the specific metallurgical alloy, dictate the precise laser wattage required to melt that specific powder, and establish the thermal cooling parameters. Every single variable must be locked down because this entire manufacturing process must eventually be submitted to the FDA for a 510(k) clearance.
So phase 1 generates consulting and engineering revenue, but no massive hardware sales yet. The intellectual property is just being formed.
Right. Once the process is locked and the regulatory pathways are cleared, they transition into phase 2, low to intermediate volume part production.
Okay, so at this stage, the client is ready to begin clinical trials or localized market rollouts, but they are not ready to drop $20 million to build their own internal 3D printing factory yet.
No, so 3D Systems acts as a contract manufacturer. They use their own internal fleet of printers in their own facilities to manufacture the knee replacements for the client.
This creates a recurring revenue stream of part sales while serving as a massive proof of concept.
Exactly. The client proves that the economics work at scale and that the clinical data supports broader adoption.
Which finally triggers phase 3.
Full system sales. This is the inflection point.
Their big payout.
The client decides to internalize the production to capture higher margins and control their own supply chain. They purchase the fleets of DMP 350 machines, they buy the proprietary software to run them, and crucially, they are locked into buying the certified titanium powder from 3D Systems for the lifespan of those machines.
Yeah, they had to buy the powder from them?
Because the FDA approval is tied to that specific printer using that specific powder, if the client tries to save a few bucks by buying generic titanium powder from a third party, they literally void their FDA clearance.
Oh, wow. It is the ultimate razor and blades business model, but protected by federal health regulations.
It's brilliant. And Dr. Graves noted that they have a major global healthcare customer currently operating in the phase 1 and phase 2 know-how transfer stages, and they expect this specific client to transition into phase 3 high-volume manufacturing by 2027.
2027. That timeline is vital for retail investors to digest. The engineering work being done today, right now in Q1 2026, is laying the groundwork for massive capital equipment sales 12 to 18 months from now.
Yeah, you cannot judge the success of the MedTech segment on a quarter-to-quarter basis. You have to look at the pipeline of clients moving through these 3 phases.
Beyond the orthopedic implant market, management also highlighted rapid expansion into highly customized surgical applications, specifically oncology and trauma response.
Yeah.
Printing custom implants for bone cancer patients. I mean, the logistics of that must be incredibly complex.
It relies entirely on a digital workflow. An oncologist takes a CT scan of a patient with a bone tumor. That 3D imaging data is sent directly to 3D Systems.
Okay.
Software engineers isolate the tumor, virtually plan the surgical excision, and then design a custom implant that will perfectly bridge the specific gap left in the patient's skeleton.
They are literally printing the puzzle piece to fit the unique geometry of the extraction.
Exactly. And the competitive advantage here is speed. Dr. Graves stated they have compressed the turnaround time for these patient-specific implants to just a few days.
That's incredible.
And this speed has allowed them to branch out from scheduled oncology procedures into emergent trauma cases, such as severe automotive accidents.
Where a reconstructive surgeon needs a custom maxillofacial or cranial implant fabricated almost immediately.
Yes.
I mean, moving from the slow, deliberate world of planned orthopedics into the chaotic, high-velocity world of emergency room trauma is a massive validation of their manufacturing reliability.
Oh, without a doubt.
If a printer goes down during a scheduled production run of knee joints, it's an annoyance. If a printer goes down while printing a cranial plate for a trauma victim waiting in the ICU, it's a catastrophic failure.
Right, lives are on the line.
The fact that hospitals trust them with the latter speaks volumes.
It's a testament to the maturity of the underlying technology. It has evolved from a rapid prototyping novelty into critical medical infrastructure.
Okay, that covers the MedTech side of the healthcare segment. Let's pivot to the dental division, which delivered an absolute blockbuster quarter.
It really did.
And the first major driver of dental revenue wasn't a new piece of hardware, but rather the resolution of just a bizarre legal bottleneck.
You're referring to the Vertex trademark approval. It is a fascinating case study in how non-technical barriers can artificially suppress market expansion.
Right. According to the call, 3D Systems owns a portfolio of prosthetic materials used for tooth repair under the brand name Vertex. This material has been fully approved, heavily utilized, and widely trusted by dental labs across the European Union for years. It's a proven commodity, but they were completely barred from selling it in the United States.
Yeah.
Not because the FDA found a flaw in the polymer chemistry, but because they were entangled in a protracted intellectual property dispute over the trademark name itself.
The clinical safety of the product was entirely irrelevant. They were locked out of the largest healthcare market on Earth over a branding conflict.
A name.
However, late last year, they finally secured U.S. regulatory approval for the trademark, completely dissolving the legal barrier.
And the CFO highlighted the immediate financial impact of this. Just by gaining the legal right to print the word Vertex on the bottles they sell in the U.S., they effectively doubled their total addressable market overnight.
And that unleashed pent-up demand. They saw a massive surge in U.S. dentists and labs adopting the workflow, which directly fueled the double-digit growth in dental material sales this quarter.
It's an incredible windfall, but it pales in comparison to the hardware launch that management dedicated a massive portion of the call to discussing.
The Next Dent 300.
Yes, Dr. Graves called the Next Dent 300 jetted denture system the most successful new product launch since my arrival at 3D Systems 5 years ago. Given the volume of products they released, that is a staggering superlative.
It is.
Let's break down the mechanics of the Next Dent 300. Why is a denture printer generating this level of executive euphoria?
Well, to understand the disruption, you have to understand the excruciating inefficiency of the legacy denture market. Historically, crafting a denture is a highly analog, labor-intensive, artisanal process.
Yeah, the patient bites down into a tray of alginate goo to make a physical mold. We've all been there.
Exactly. That physical impression is shipped to a dental lab. A technician pours plaster into the mold to create a model of the patient's mouth.
Sounds messy.
It is. They then handcraft a wax mock-up, manually setting individual pre-manufactured acrylic teeth into the wax to ensure the bite alignment is correct. The patient has to return to the dentist to try on the wax mock-up. If it fits, it goes back to the lab, where the wax is melted away and replaced with hard pink acrylic through a complex boiling and pressing process.
It requires multiple patient visits, extensive manual labor by highly trained technicians, and massive logistical overhead shipping physical models back and forth.
The Next Dent 300 obliterates that entire analog supply chain.
Good.
It introduces a fully digital workflow utilizing advanced material jetting technology to produce monolithic dentures.
Now, the term monolithic is the key differentiator here,
Yeah.
right? Because many early dental 3D printers used the stereolithography or SLA process.
Right.
They had a vat of liquid pink resin to print the gums and a separate vat of white resin to print the teeth. A technician still had to manually glue the printed teeth into the printed gums, which introduced structural weak points where the adhesive could fail.
The Next Dent 300 bypasses the vat entirely. It utilizes an array of print heads that jet microscopic droplets of multiple different photopolymer materials simultaneously.
It prints everything at once.
Yes. It jets the rigid, tooth-colored resin for the crowns, alongside the flexible, pink-tinted resin for the gingival base, curing them instantly with UV light layer by layer.
Wow.
The entire denture teeth and gums is fabricated as a single, continuous, monolithic structure without any assembly required.
The structural integrity must be vastly superior, and the elimination of manual labor for the dental lab is profound.
Oh, absolutely.
The transcript highlighted a specific deployment case study that illustrates the economic impact of this. They cited Rowe Dental Laboratory, which is one of the premier full-service digital dental labs in the United States.
Right, and Rowe Dental Laboratory didn't just buy a single machine. They deployed an extensive fleet of Next Dent 300 systems.
And what happened?
The CEO of the lab, B.J. Kowalski, provided a quote that management eagerly shared. He stated that integrating these jetted systems allowed the lab to effectively triple their production output.
Tripling output without tripling your labor force or your factory floor space. For a dental lab operating on tight margins, that is a transformative removal of a production bottleneck.
It completely changes the economics.
You scan the patient's mouth digitally with an intraoral wand, email the file to the lab, and the monolithic denture is printed perfectly the first time.
And the total addressable market for this specific solution is staggering. Dr. Graves noted that they recently secured the EU phase IIA medical device approval for this specific denture solution, arriving 2 months ahead of their internal schedule.
Nice. And combining the EU clearance with their existing US approvals unlocks a massive demographic.
It really does.
He cited that the expanded addressable market now encompasses over 60 million edentulous patients. 60 million people who require full or partial arch replacements.
That represents roughly 1/3 of the total global market for this procedure. It is a multi-billion-dollar legacy industry that is ripe for complete digital disruption, and 3D Systems has positioned the Next Dent 300 as the primary architectural platform for that transition.
So, summarizing the healthcare segment, MedTech is securing long-term, high-margin contracts for titanium implants, while dental is capturing immediate windfall revenue from trademark approvals and disrupting a massive legacy market with material jetting.
It's a phenomenal narrative.
It is. But to keep our analysis balanced, we have to look at the other half of the company. Let's step out of the hospital and onto the factory floor to examine industrial solutions.
Right, the industrial side. And the industrial segment presented a much more muted headline number, growing at just 1.6% year over year to hit $45.4 million.
Yeah, quite a difference from 21%.
Exactly. In the context of a sluggish global manufacturing environment, avoiding a contraction is commendable, but it hardly screams hypergrowth.
However, beneath that tepid 1.6% average, there was a specific subsector that absolutely exploded. Aerospace and Defense, or A&D, was the undisputed star of the industrial side, posting year-over-year growth exceeding 20%.
The dynamics driving A&D are remarkably similar to those driving MedTech. It is an industry entirely consumed with fabricating highly complex, structurally critical metal parts where failure is not an option.
Right.
And Dr. Graves used the earnings call to deliver a highly technical seminar on the two distinct manufacturing modalities they employ to service these aerospace prime contractors.
Let's break down those two paths because it highlights the technological nuance required to operate at this tier of manufacturing. The first path is direct metal printing, which we discussed in the context of spinal implants.
Lasers melting beds of titanium powder.
Right. But Dr. Graves made a very pointed, almost aggressive remark regarding the chemistry of this process.
He emphasized the absolute absence of binders in their DMP process.
Binders.
Yeah. This is a critical competitive distinction against a rival technology known as binder jetting.
Okay, explain binder jetting.
In binder jetting, the printer deposits a liquid binding agent, essentially a specialized glue onto the metal powder to hold the shape together. Once the part is printed, it is highly fragile, known as a green part.
So it's not actually solid metal yet.
Exactly. It then has to be placed into a high-temperature sintering furnace to burn away the glue and fuse the metal particles together.
The problem being that burning away the binder often leaves microscopic pores or trace chemical contaminants within the molecular structure of the metal.
Which is a huge issue.
If you are printing a paperweight, porosity doesn't matter. If you are printing a structural bracket for a lunar lander that will experience violent vibrational forces during launch, a microscopic pore becomes a stress fracture and the mission fails.
Exactly. Dr. Graves stated emphatically, customers that do not have this technology will simply not be able to participate in this high-value portion of the market. It wasn't just marketing bravado, it is a rigid engineering reality. The structural integrity requirements dictated by the FAA and the Department of Defense essentially mandate binder-free fusion for flight-critical components.
So direct metal printing is path one. What is the second modality they're utilizing for aerospace clients?
The second path is an intricate modernization of one of humanity's oldest metallurgical techniques, investment casting, traditionally known as the lost wax process.
The basic mechanics of investment casting haven't changed in millennia.
No, they haven't.
You hand carve a replica of your desired part out of wax. You dip that wax model repeatedly into a ceramic slurry until it builds up a thick, hard shell. You bake the shell. The wax melts and drains out, hence lost wax, leaving a perfect hollow ceramic cavity.
Right.
You then pour molten liquid metal into the cavity. Once it cools, you shatter the ceramic shell, and you have your metal part.
And it is incredibly effective for creating large, complex geometries out of exotic alloys. The bottleneck in the modern aerospace industry is the creation of that initial wax pattern.
Because it's so manual.
Exactly.
Yeah.
Hand carving or even CNC machining complex wax patterns for a massive turbine engine requires specialized tooling, significant manual labor, and enormous lead times.
This is where 3D Systems intervenes. They don't replace the casting foundry, they replace the wax.
Yes.
They utilize massive stereolithography, or SLA, printers to fabricate the initial pattern out of a highly specialized, caftable photopolymer resin.
They can print an incredibly complex pattern overnight, complete with internal geometries that would be impossible to carve by hand.
And then
The foundry takes that 3D printed resin pattern and runs it through their standard ceramic coating and burnout process.
my question is, if they possess the direct metal printers capable of fusing titanium, why bother with the multi-step casting process at all? Why not just print the final metal part directly and skip the foundry entirely?
It comes down to material physics and scale constraints.
Okay.
Direct metal printing is phenomenal, but it is currently limited by the physical size of the powder bed chamber. You cannot easily print a continuous metal structure that is 3 meters long in a single pass.
That makes sense.
Furthermore, there are specific superalloys. Certain high-temperature nickel-based alloys used in the hottest sections of a jet engine that do not react well to the rapid heating and cooling cycles of a laser powder bed. Their crystalline structure becomes brittle.
So for massive components or hyper-specific exotic alloys, you must pour the molten metal slowly to ensure the correct metallurgical properties.
Precisely. By providing both the DMP systems for direct fabrication and the massive SLA systems for advanced casting patterns, 3D Systems can service the entirety of an aerospace prime contractor's needs.
A one-stop shop.
Yeah.
Yeah.
And Dr. Graves explicitly noted that next-generation aerospace systems, particularly rockets and hypersonic vehicles, increasingly require a hybridized approach utilizing both methods simultaneously.
He grounded this theoretical discussion with two very specific, tangible examples of components currently moving into mass production.
Right.
The first was titanium antenna brackets for satellite constellations.
By utilizing topological optimization software in conjunction with direct metal printing, they were able to completely redesign the geometry of the bracket. The resulting printed component is 25% lighter than the legacy machine version, and it is produced in half the time.
And in the economics of low Earth orbit satellite deployments, where launch costs are literally calculated by the kilogram, stripping 25% of the mass out of a structural component without sacrificing strength is an astronomical value proposition.
Oh, it pays for itself immediately.
The second example he provided was the mass production of turbine blades for advanced jet engines and industrial power generation turbines.
The limiting factor on the thrust and efficiency of a jet engine is the temperature at which the fuel burns.
Right.
The hotter the burn, the more efficient the engine. But if you burn the fuel too hot, you melt the turbine blades.
So how does 3D printing solve a thermodynamic limitation?
By allowing engineers to design microscopic serpentine cooling channels winding throughout the interior of the solid metal turbine blade.
Like little air conditioning ducts inside the metal.
Exactly. Air is forced through these internal channels, actively cooling the blade from the inside out while it operates in an environment that actually exceeds the melting point of the metal itself.
Because you cannot take a solid block of metal and drill a curving, snake-like tunnel through the center of it with a standard drill bit. It is geometrically impossible. with subtractive manufacturing.
But if you build the blade layer by layer, or print the complex internal ceramic cores used in the casting process layer by layer, you can easily incorporate those intricate cooling channels.
That's brilliant.
It allows the aerospace manufacturer to push the thermal limits of the engine, drastically increasing fuel efficiency and thrust.
So if I can distill the entire industrial segment narrative into a single analogy, it appears 3D Systems has completely abandoned the minor leagues.
Yeah, that's a good way to put it.
They stopped fighting for margin on desktop printers, making plastic architectural models, or prototyping Yoda heads. They've transitioned their entire industrial apparatus to focus exclusively on the highest stakes, highest margin manufacturing on Earth. They traded Yoda heads for titanium spinal taps, satellite brackets, and internal cooling channels for hypersonic jet engines.
It is a profound evolution. We're witnessing additive manufacturing definitively break out of the R&D laboratory and establish itself as a primary, non-negotiable tool for full-scale, end-use production in the most rigorous environments imaginable.
Okay, we have painted an incredibly rosy picture so far.
We have.
We've examined the impressive Q1 top-line growth, the ruthless cost-cutting that drove EBITDA positive, the strategic brilliance of the segment flip, and the high-tech marvels of the medical and aerospace divisions. The retrospective data is fantastic. But this brings us to the third crucial step of our Talk Tickers framework, management guidance. We have to look forward. And when we transition to their projections for Q2 2026, the narrative hits a massive, glaring pothole.
The forward guidance provided a sharp dose of reality to counter the Q1 euphoria.
The numbers are undeniably weak. Management guided for Q2 2026 revenue to land between $93 million and $95 million. Even at the absolute top end of that range, $95 million represents a sequential decline from the $95.5 million they just delivered in Q1.
Yeah.
But more alarmingly, they are projecting an adjusted EBITDA loss of between $2 million and $4 million.
They are actively forecasting a regression. After celebrating the massive turnaround to a positive $2.1 million EBITDA, they're telling investors to brace for a return to unprofitability in the immediate subsequent quarter.
If I am an institutional investor or a retail shareholder listening to this call, warning sirens are blaring in my head.
Oh, for sure.
A very direct, aggressive question for Dr. Graves. If your business is fundamentally fixed, if your medical approvals are unlocking vast new markets, and if aerospace contractors are begging for your rocket components, why are you projecting a contraction? Is the underlying demand actually cracking? Or is management just sandbagging the estimates to ensure an easy beat next quarter?
And this was the focal point of the Q&A session with the financial analysts.
I bet.
The analyst hammered management on this exact discrepancy. Dr. Graves defended the guidance by pointing to two very specific compounding macro headwinds that disproportionately impact their current business model.
Let's dissect these headwinds to determine if they are legitimate operational hurdles or just convenient excuses for poor execution. Headwind number one, seasonality.
Which is a direct consequence of the segment flip. Now that healthcare is the dominant revenue engine, 3D Systems is tethered to the unique cyclical rhythms of the medical industry.
My initial reaction to hearing seasonality applied to healthcare was deep skepticism. I understand seasonality in retail. Nobody buys snowboards in July. But illness and injury don't take a summer vacation. People don't stop needing medical care based on the calendar.
They don't stop needing emergency care, but they absolutely alter their scheduling for elective care. And the vast majority of 3D Systems, medical revenue, orthopedic joint replacements, spinal fusions, dental restorations, falls firmly into the category of elective procedures.
Dr. Graves elaborated on the mechanics of patient behavior here. He noted that there is a pronounced dip in elective orthopedic surgeries during the late spring and early summer months.
The underlying logic is highly practical. Consider the recovery timeline for a total knee arthroplasty. The patient is looking at weeks of limited mobility, followed by months of intensive physical therapy.
Right.
Families do not want to endure that recovery process during the summer when children are out of school and family vacations are scheduled. They prefer to manage their joint pain with therapeutics through the summer and then schedule the invasive surgery for the fall or early winter.
There's also a major financial mechanism driving this cycle, the structure of American health insurance deductibles.
Exactly.
Patients typically spend the first half of the year paying out of pocket to meet their high deductibles through routine care and prescriptions. By the time fall arrives, the deductible is met, and the insurance company is on the hook for the bulk of the cost. So financially, it makes sense to stack expensive elective surgeries at the end of the calendar year.
Exactly. Because 3D Systems is essentially a supplier to the operating room, their hardware utilization rates and material sales mirror this exact cadence. The Q2 slump in healthcare is a structural reality of the market they dominate, not a loss of competitive market share.
Okay, the seasonality argument is mechanically sound. It represents deferred revenue, not destroyed demand. What was the second major headwind they cited for the Q2 contraction?
The second headwind is rooted in macro geopolitics, specifically the ongoing conflicts and instability in the Middle East.
Again, as an investor, my skepticism radar pings loudly. Whenever a mid-cap manufacturing company headquartered in Rock Hill, South Carolina, blames the Middle East for a quarterly earnings miss, it usually sounds like a desperate attempt to deflect blame onto uncontrollable global events. Connect the dots for me. How does localized conflict half a world away drag down their EBITDA?
It impacts them through the catastrophic disruption of global shipping logistics. The conflict has essentially choked off the Red Sea and the Suez Canal to commercial freight. Cargo ships are being forced to reroute entirely around the Cape of Good Hope at the southern tip of Africa,
Which adds weeks of transit time and astronomical fuel costs to every container shipped between Europe, Asia, and the Middle East.
Precisely. And 3D Systems relies heavily on the steady flow of physical goods. They have to ship massive hardware platforms, delicate replacement lasers, and temperature-sensitive vats of photopolymer resins across the globe.
Right.
The CFO noted that the extended shipping durations and the surge in container costs are directly eroding their margins and delaying revenue recognition because products are literally sitting on the water for an extra 14 days.
Interestingly, she highlighted one specific, seemingly niche subsegment of their industrial portfolio that was taking the brunt of this logistical nightmare: the jewelry business.
Which sounds completely incongruous when we've spent the last hour discussing spinal implants and rocket nozzles.
Right.
But additive manufacturing is actually the backbone of the modern high-end jewelry trade.
Walk me through that workflow, because I assume they aren't printing solid gold rings directly out of a powder bed.
No, they utilize a highly refined version of the investment casting process we discussed earlier for aerospace. A jewelry designer creates an intricate diamond-encrusted ring in a CAD program.
Right.
3D Systems provides specialized SLA printers that utilize a proprietary wax-like resin to print a perfect high-resolution master pattern of the ring. That printed resin pattern is then used by the jeweler to cast the final piece in gold or platinum.
And how does the Middle East factor into this specific supply chain?
Dubai is one of the central hubs of the global gold and jewelry trade. There is a massive concentration of high-volume jewelry manufacturing facilities in the region that rely entirely on the continuous delivery of 3D Systems' specialized castable resins. When the shipping lanes into the region are heavily disrupted, that highly lucrative recurring materials revenue stream just bottlenecks. If the resin can't reach the facility, the printers sit idle and the revenue evaporates.
So management is attributing the Q2 slump to the predictable summer vacation schedule for knee replacements and the unpredictable chaos of global maritime logistics.
Yes.
Both are external forces, but they still result in a negative EBITDA print. Is there any silver lining provided in the guidance, or are investors just supposed to buckle up for a dismal summer?
Management provided two significant counterweights to the Q2 gloom. First, despite the immediate near-term turbulence, they aggressively reaffirmed their full-year guidance.
Okay.
They stated unequivocally that they still expect to achieve break-even adjusted EBITDA or better for the entirety of 2026.
Which implies that whatever cash they burn in Q2, they are highly confident they will over-earn and recapture in the back half of the year as the elective surgery cycle ramps up and the cost-cutting measures reach maximum effect.
Exactly. They view Q2 as a transitional trough, not a structural decline. But the second, much more tangible catalyst arriving in the late summer is the massive infrastructure expansion they are bringing online in Littleton, Colorado.
The Littleton facility. Dr. Graves spoke about this project with a level of intensity that suggested it is central to their entire industrial growth thesis moving forward.
3D Systems is currently completing an 80,000 square foot expansion to their manufacturing footprint in Littleton.
That's huge.
And this is not generic warehouse space for storing inventory. This is a highly secure, purpose-built facility dedicated exclusively to the production of high-end metal components.
They're building an advanced foundry to feed the aerospace and defense sector.
Precisely. Dr. Graves noted that their current metal manufacturing facilities are effectively maxed out. They have more demand from defense prime contractors and aerospace companies than they have physical capacity to fulfill.
A good problem to have.
For sure. The Littleton expansion is designed specifically to clear that backlog and capture the surging demand anticipated in Q3 and Q4.
He listed some of the specific exotic alloys that this facility is calibrated to process, and it reads like a metallurgical wish list for the Pentagon.
It really does.
They are scaling up capacity for titanium, which is standard for aerospace structures. They mentioned zirconium, which has highly specialized applications in nuclear reactors and chemical processing due to its extreme corrosion resistance. But the alloy that caught my attention was copper nickel.
The expansion of copper-nickel printing capabilities is a direct indicator of their deepening entrenchment within the maritime defense sector.
Specifically, the United States Navy. Why is the Navy suddenly demanding 3D-printed copper-nickel parts?
Copper-nickel alloys possess an extraordinary resistance to corrosion and biofouling in harsh, deep-sea saltwater environments. It is the premier material for fabricating critical components: valves, heat exchangers, specialized piping for nuclear submarines, and surface fleet vessels.
Historically, casting those complex geometries out of copper nickel is incredibly difficult and leads to massive supply chain bottlenecks for the naval shipyards.
The ability to additively manufacture those parts on demand with complex internal geometries optimized for fluid dynamics drastically accelerates the maintenance and construction schedules for the fleet. By standing up the Littleton facility, 3D Systems is positioning itself not just as a supplier of printers, but as a primary contract manufacturer of classified, flight-critical, and mission-critical hardware for the Department of Defense.
So if we synthesize the forward guidance, Q2 is going to be messy.
Very messy.
The numbers will likely contract due to surgical seasonality and shipping delays. But that short-term pain is bridging the gap to a back half of the year where the massive defense factory comes online and the healthcare cycle hits its peak.
That is the narrative architecture management has constructed.
Which brings us to the final and arguably most critical segment of our Talk Tickers framework. The bottom line. We have sifted through the data, analyzed the strategy, and evaluated the guidance. Now we must distill all of this complexity into an actionable verdict.
Right.
So I will pose the ultimate question to you. If you are a retail investor currently holding DDD in your portfolio, watching the stock price fluctuate, or if you are sitting on a pile of cash looking for an entry point into the advanced manufacturing sector, based purely on the fundamentals of this Q1 2026 earnings call, is this a bullish or a bearish signal?
If we strip away the market sentiment and weigh the fundamental operational evidence impartially, the verdict for the long-term patient investor has to be a bullish signal.
Bullish. Okay, I need you to defend that thesis, build a bull case. What are the foundational pillars supporting that verdict?
The bullish rationale rests on three interlocking pillars: demonstrated execution, regulatory moats, and macro alignment.
Let's start with execution.
The hardest thing for any management team to do is fundamentally change the operating leverage of a legacy company. Over the past 2 years, analysts rightly questioned whether 3D Systems could survive the capital expenditure freeze without diluting shareholders to oblivion.
They were burning cash and the market was losing faith.
But this quarter, they proved they could execute a complex turnaround. They grew the top line by 11% while simultaneously executing a 35% reduction in operating expenses. They successfully digested the loss of their high-margin software divisions and still managed to orchestrate a $28 million positive swing in adjusted EBITDA.
It's impressive.
That is not accounting magic. That is textbook, brutal, effective operational execution. They prove they can run the machine lean.
Pillar 1 is execution. They stop the bleeding. What is Pillar 2?
Pillar 2 is the deepening of their regulatory moats. The additive manufacturing space is crowded with startups promising faster lasers and cheaper resins. But technology alone doesn't win enterprise contracts in heavily regulated industries.
You can build the greatest printer in the world, but if the FDA won't let a hospital use it, it's a very expensive paperweight.
Exactly. The intrinsic value of 3D Systems lies in their regulatory capture. Achieving FDA clearance for the Vertex materials, guiding the Next Dent denture system through the rigorous EU phase III medical device approval process, establishing the validated metallurgical parameters required by the FAA for titanium flight hardware.
It takes forever.
It does. These accomplishments require years of data collection, clinical trials, and massive legal expenditure.
A Silicon Valley startup cannot disrupt that with a clever algorithm.
The barrier to entry is immense, and once 3D Systems is designed into a medical workflow or an aerospace platform, the switching costs for the customer are astronomical. A hospital is not going to tear up their FDA-approved spinal implant manufacturing process to save 5% on a competitor's machine.
They just won't.
The vendor lock-in is profound, and it guarantees long-term, sticky, recurring revenue for materials.
Execution and moats. What is the third pillar?
Macro alignment. Look at where they have concentrated their R&D and their manufacturing capacity. They are perfectly positioned at the intersection of the two most massive, inevitable global megatrends. First, demographic aging. As the global population ages, the demand for joint replacements, spinal fusions, and restorative dentistry is locked into an upward trajectory for decades.
And the second trend?
Geopolitical instability. The world is fracturing, leading to the short-term bear case is entirely predicated on the Q2 guidance. The market hates uncertainty, and it despises sequential contractions. Management has clearly telegraphed that revenue will likely drop in Q2 and that EBITDA will slide back into negative territory.
And while they blame seasonality and the Red Sea logistics, the market might interpret the miss as a deeper structural flaw or a failure of the sales team to close deals.
Precisely. If you are a short-term swing trader looking for a quick momentum pop over the next 30 days, the guidance suggests you're going to encounter severe turbulence. The stock will likely experience volatility as the market attempts to digest a messy, unprofitable summer quarter.
But if your time horizon extends beyond the next earnings call, if you are looking out to 2027, when that Phase 3 medical client finally transitions into high-volume manufacturing and buys a fleet of DMP-350s, and when the Littleton facility is fully operational, churning out classified copper-nickel components for the Navy submarine fleet, the underlying structural foundation of the company looks stronger, leaner, and more defensible than it has in a decade.
It requires the investor to endure short-term pain to capture long-term structural gain.
We have covered an immense amount of ground today in this Talk Tickers deep dive. We have navigated the granular accounting of adjusted EBITDA, explored the biological mechanics of bone fusing to 3D printed titanium lattices, analyzed the thermal physics of internal cooling channels and jet engines, and dissected the macroeconomic impact of shipping lanes on the Dubai jewelry trade. I want to thank you, the listener, for sticking with us as we unpack this incredibly dense, complex earnings call.
The narrative of 3D Systems represents the broader maturation of the additive manufacturing industry. It is a story of moving past the hype and doing the grueling work of industrial integration.
It truly is. And before we conclude this deep dive, I want to leave you, the listener, with one final overarching thought to mull over. A thought that challenges the fundamental way Wall Street categorizes this company. Well, for the past 20 years, 3D Systems has been rigidly classified as a volatile tech stock. It was grouped in with the software-as-a-service companies and the consumer electronics manufacturers, riding the wild, speculative hype cycles of Silicon Valley innovation.
Which is why the stock chart looks like an electrocardiogram of a patient in distress.
Exactly. But look at the reality of what this company is actually doing today. Look at the revenue drivers we just discussed. They are mass-producing flight-critical rocket engine components. They are printing custom titanium spinal implants for trauma victims. They are opening an 80,000 square foot foundry specifically to fabricate exotic copper-nickel alloys for United States Navy submarines.
Yeah.
At what point does the market stop evaluating 3D Systems as a speculative, volatile technology startup and begin re-rating them as an essential, entrenched, primary defense and medical contractor?
A re-rating of that magnitude would fundamentally alter their valuation multiples, shifting them from a speculative tech multiple to the steady, reliable multiples commanded by legacy aerospace and healthcare primes.
Because the next time you pull up the stock chart for DDD, remember the X-ray metaphor. The surface chart might look jagged, chaotic, and messy, reflecting the short-term noise of seasonal slumps and shipping delays.
Right.
But if you look deeper into the structural data, past the muddy waters of the quarterly guidance, you might find that the underlying bone structure, the defense contracts, the FDA regulatory moats, the brutally lean operating expenses, is finally starting to fuse together and heal. Stay analytical, keep digging into the raw data, ignore the surface noise, and we will catch you on the next deep dive.